All right, folks, the number you've been waiting for, AT&T just out with results. Looking through these numbers right now, it looks like on the fourth quarter, on an adjusted basis, they had earnings per share of 61 cents. That compares to the 57 cents that the street was anticipating. In terms of revenue, $31.3 billion. We had $31.38 billion as a number the street might be looking for. Let me run you through, because there's a lot of metrics that they're kind of going through and that matter to the street. Free cash flow. They came in with free cash flow of more than $14 billion for the full year. They say they reduced their net debt by $24 billion in 2022, and also say that using cash after dividends to pay down debt remains a top priority. I guess if you're an investor, you're listening for after dividends, paying down the debt, sounding like the dividend is safe. I think at this point they have about 95% of the debt that they do have is fixed at the average rate of about 4%. They say they achieved more than $5 billion of a $6 billion run rate cost savings target at the end of the year. And again, one thing I should probably point out here, adjustments for the fourth quarter include a $25 billion non-cash goodwill impairment charge in the fourth quarter that is driven primarily by rising interest rates and taking in conjunction with annual goodwill assessments that they do. For 2023, the outlook is what matters. Wireless service revenue growth of 4% or higher. I think that's a little better than the street was expecting. Broadband revenue growth of 5% or higher, also a little better. Adjusted EBITDA growth of about 3% or higher. That's at least in line with what the street was looking for. Adjusted earnings per share for the full year, $2.35 to $2.45. That's below what the street was looking for of $2.56, but it looks like they're saying this is because of a change in pension accounting. Higher interest rates force them to take that higher, value asset base. They have to discount. The discount rate goes up as a result of the higher interest cost. And so on a numbers basis, they have to accrue that cost, the present value of where the pension would be. I don't believe it's something that requires additional cash at this point. Other things that they're looking for, free cash flow of about $16 billion or better. That would be up $2 billion from 2022. And capital investment of about $24 billion, which would be consistent with 2022 levels. Remember, we talked to Verizon yesterday, and they were lowering their CapEx. They said after years of investing in 5G, but it looks like AT&T is going to continue investing at those levels. Probably something that matters is postpaid net adds for the full year, 2.9 million. If you're looking at churn for the fourth quarter, churn postpaid rate was 0.84%. That's a little better than they had before. Postpaid 1.01%. 2022, they said, was the most profitable year ever for AT&T's mobility business. You can see that stock down by about 4 cents. So we'll see where it trades.